Hey y'all, it's Carolyn Bauerschlag with Bauerschlag Group at Keller Williams out of Houston, Texas. I promised my people an investor series a couple of weeks ago, and I thought I'd get my tech a little bit better. Regrettably, tech is not my bit, so I have a couple of cardboard boxes stacked up on a rolling chair. So in the spirit of progress over perfection, here we go. We have a 5-part series, and this is part 1. I wanted to cover the very basics of why real estate investment is a great idea. This may seem obvious to a lot of you. Some of you may say, well, assets appreciate, and that's great, and you make some money, and why wouldn't you do it? But there's a real component of risk that people get hung up on, myself included, that made it hard for, let's say, me personally to do this, and so I figured it might be hard for some of you to consider it. So I thought, education makes everything better. So I've broken this up into 3 sections for today. So we're going to cover putting your money to work. We're going to cover the tax benefits, and we're going to cover how to use some undercapitalized cash. So for me personally, the part that I really was stuck on was the idea of just assuming more and more debt. And if you're an adult learner, you may have a hard time listening to a message until you're ready to hear it. That's part 1. You have to be receptive. And then part 2 is that you may have to learn it or hear it 7 or 8 different times before the message actually registers. So in July of last year, I attended a seminar led by Wendy Papasan out of Austin, Texas. She's known for building wealth for her clients and for herself through real estate. And I had the good fortune of sitting in her class. And we're going to go over some of the things that she said that really were aha moments for me. So first part, let's talk about putting your money to work. If you have invested in anything before, stocks, bonds, mutual funds, you are going to hear from your financial advisor. They're going to say, hey, a 6 to 8 to maybe 10% return is a really good return on investment for whatever you're investing in. So that risk that you're assuming should be rewarded in the term or in the line of like 6 to 10% annually. And when people come to me and they're thinking about investing in real estate, they usually can wrap their mind around 2 pieces of the return that you get from investing in real estate, but they often forget about the third. So the first part is appreciation. And I would say more than half of the people that I talk to don't consider this as part of that real estate investment return. So National Association of Realtors tells us every single year your house improves by about 3 to 5% each year in value, meaning it increases with inflation or does slightly better depending on market condition and circumstances in the capital markets. So 3 to 5% appreciation on that asset is something to not forget. Another thought around appreciation is that you don't get to realize that appreciation until you sell the asset. But what I like to push back on there is that you don't get to realize the appreciation in your 401k until you pull it out. Same with your Roth IRA or any other investment vehicle. Most of these appreciation or these capital gains aren't realized until you sell them anyways, right? So then the next part is cash flow. Cash flow is pretty easy for everyone to wrap their head around because I've never had a client come to me and say, I want to buy some real estate so that it can lose some money. Almost everybody is focused on making sure that they do get some money on that real estate investment. But what they are surprised to find is that you may only make $200 to $300 a month on your real estate investment. And in the state of Texas, where we pay property taxes, that's actually a really good thing. So if you're outside of Texas or if you listen to podcasts like Bigger Pockets or you're part of some other think tanks like Lifestyles Unlimited, they may be speaking to an audience in a state that does not pay property taxes. But here in Texas, that profit that you would have monthly is getting eaten up to the tune of $400 to $500 a month in property taxes. So if we're looking at somewhere around $2,400 to $3,600 a year on money made on your real estate investment, that's actually pretty great. When you stack that against, let's say, a $200,000 asset, we're looking at a 1.5% to 2% return. So appreciation by itself isn't really a compelling reason to invest in real estate as a secondary investment. And cash flow by itself isn't really all that compelling either. But when we put them together, we're now at about 4.5% to 7% appreciation, which is starting to sound better, or closer to that 6 to 10% that your financial advisors may be coaching you on. So here's the part where I was really hung up, and this is what Wendy Papasan helped me with. Debt reduction. If you're not considering the debt reduction and the overall return on your asset, you're not doing the full calculation here. So I get made fun of by my peer group because I actually love an amortization schedule. One of my favorite things is to look at an amortization table and see how each payment takes down my total debt. So if I bought a $200,000 asset and I financed $160,000 in a given year, my monthly payments would take that debt down maybe $3,000 to $4,000. When we stack up that $3,000 to $4,000 against the total asset value, again, we're looking at 1-ish to 2% in your equity position in the home, meaning the return that you get is now the summation of your appreciation, your cash flow, and the debt reduction. So we're looking probably somewhere closer to 5.5% to 9% instead of it only being one of these three in isolation. So to revisit this last bit here on the debt bit, for me personally, that's where Andy and I really got caught up in not wanting to pursue this. Really, Andy was on board, and I was the one who was pumping the brakes because I was a little bit afraid, right? So my daily work is in real estate. We already owned real estate. We had a mortgage payment, and so I was hesitant to put more money into real estate, frankly. And it wasn't until Wendy said over and over again, every single payment that comes into your bank account from the tenant, that tenant is paying your debt for you. The tenant's assuming the risk. You are not necessarily the one who's on the hook for that recurring debt payment every single month. Are there vacancies? Sure. Are there potential damages? Yeah. But in the main, your tenant is paying your debt for you. So now when we look at this together, 5.5% to 9% really starts to make sense for the type of return that you would expect on the type of risk that you are taking. Good? Okay. So next bit is tax benefits. So I know enough to know that I am not a tax accountant. I am a CPA, but I was in the audit space. I know what I don't know. So if you need to get good tax advice, talk to your tax accountant. But this is just a high-level overview. So when you own an asset and you're not occupying that asset, you've put that asset to work, called your investment property, the government blesses you with something called depreciation. They say, hey, great news, you bought an asset, that asset's going to be worth less every single year in the eyes of the IRS. Woohoo! So what that means is if you bought a $200,000 asset and we can depreciate the value of the building, not the land, let's say $150,000 of it is attributable towards the asset. We get to take that $150,000 and divide it over 27 and a half years, which means that every single year you get to take a $5,000 to $6,000 reduction against your taxable income when you file your annual taxes. So it's a non-cash deduction that you get to take each and every year for the privilege of having owned your investment property. Not bad, right? The next bit, this is one that I was personally hung up on, and I called my tax accountant because I needed a little bit better advice than what I could Google. So capital gains are what you pay on an asset that you don't occupy whenever you sell it. So for your investment property, if you go to sell your home, you don't have that homestead exemption protection, meaning you're going to pay taxes on your capital gains. So what is that capital gain? I had thought about it in the context of the money that you walk away with from the title company, but then I thought about it a little bit longer and I thought, no, that's not it. What it is it's your fair value of the asset when you sell it, meaning your contract price. So it's the fair value of that asset when you sell it less your cost basis. Your cost basis is equal to maybe what you paid for it. Then you get to subtract out your depreciation, and then you get to add in the things that you paid to improve the property. So it's not a bad deal. So if you kind of put some numbers to it, let's say that we sold our asset today for $250,000 and that we subtract out our cost basis. We've been saying we bought it for $200,000. Let's say we dumped $15,000 into it in the form of an AC, roof, light fixtures, stuff, flooring, and then we depreciated maybe $30,000 worth of that asset. That brings us to a cost basis now of $185,000. So we take $250,000 less $185,000, and we're looking at paying taxes on $65,000 whenever we sell, versus maybe paying taxes on $100,000 or $125,000 or whatever it is that you're returning when you walk out of the title company, which is not a bad deal. So those two thoughts. Call me if you have questions. Next, utilizing some undercapitalized cash. Many of the people who've approached me and said that they want to invest in real estate have maybe exhausted some of the traditionally available tax deferred protections that we have, like a 401k, a SEP IRA, a Roth IRA, a health savings account, you name it, they've already done it. They've done their charitable contributions, and then they've got this extra cash laying around. And they say, instead of me keeping an extra $50,000, $60,000, $70,000, $100,000 in the bank, what can I do with this that would make sense? Yeah, you could go get bonds. Bonds yield 2% maybe. You could go put it in a money market and get 2%, but sometimes people want to put that money to work. And when you have exhausted all of the traditional tax deferred benefit sort of options, and you're looking at a chunk of change that you would like to put to work for you, what people like about real estate investment is that it is a 5.5% or 9% return, and it's actually a physical asset that you can go touch. So I'm not going to stand here and pretend to you that I understand what all of the market machinations are. I don't know how mutual funds actually improve. I don't know what the asset balance is. I don't know enough to know. But I do know how a house works, and I do know that I can go look at it and I can touch it. And I do know that a 3-bed, 2-bath home, single story somewhere in Houston, Texas will be valuable no matter what. You will always have someone who either needs to rent that property, always, and you're always going to have somebody who wants that type of property as their first time home. Maybe it's their version of the American dream, right? So in the next series, we're going to talk about the type of property that we find attractive for real estate investors. And I just touched on it. It's, spoiler alert, it's a single family 3-bed, 2-bath home, single story preferably, but we'll chat on that more. If you have questions on anything that we've covered so far today, shoot me an email, drop me a line, drop a note in the comments, and I'll be happy to chat with you. Thanks so much.